most important thing that attracts me is simplicity and diversification. So ETFs are easy to trade. With one simple trade, investors can get exposure to a really well-diversified basket of income-producing securities. Once you've got that ETF, ETFs distribute income that they receive, and if those ETFs hold Australian shares, they'll often distribute franking credits as well, which makes them attractive. There's a very wide range of ETFs, which means that investors working with a financial advisor can find that perfect balance of income and risk. So ETFs are great because of that flexibility. And finally, and not insignificantly, ETFs are normally very low cost. And so if you think about the income you earn is after the fees that you pay, the fact that ETFs are low cost makes them well suited for income-focused investors. Well, because ETFs distribute the income that they receive, that income is not going to be the same quarter to quarter or even year to year. So income from ETFs is usually not fixed. So if, for example, an ETF holds underlying company securities, then if dividends go up or dividends go down, the ETF's income will go up or down. Or if the ETF receives more income in one quarter than another quarter, those payments may not be stable. Perhaps more significantly, because the price of an ETF on the exchange will move according to its underlying investments. So if an ETF holds risky investments like emerging market shares or even normal shares, there's always a risk that the price of that ETF could drop quite significantly should share market prices drop. Something else that people often misunderstand about ETFs is that when an ETF pays income, its price on the exchange will normally drop immediately after by the amount of that income. So if it's trading at $25 on the exchange and it pays out income of 25 cents per unit, then you would expect it to start trading at $24.75 or something like that. So that's something else that investors quite often miss when they're looking at ETFs for income. And then finally, ETFs sometimes distribute capital gains as well. So that normally happens at 30 June. So sometimes ETFs at 30 June will pay the income they've earned in the quarter, but there might also be a small amount of capital gains that they distribute as well. Well, size does matter, but perhaps not in the way that most investors think. So I think of size through three different lenses. So the first lens would be from a portfolio point of view. Now, an ETF doesn't have to be particularly large to track its index. And so in most cases, you don't need a huge ETF to successfully track an index and to generate income for investors. So that's the portfolio view. From a commercial point of view, as an issuer, obviously larger ETFs generate more fees for the issuer, or they make it easier for the issuer to provide lower fees in an ETF. But ETFs are very transparent on fees and costs. So that's something that is very easy for investors to compare no matter the size of the ETF. I think where size comes into play is probably the third area, which is in trading for investors. So when you're looking at the cost of an ETF, you need to look at the total cost of ownership. So that's not only the management fee, but what it costs you to trade that ETF on the exchange. And those trading costs include brokerage, which everyone sees, but there's also an implicit cost, and that's the gap between the bid price and the offer price of the ETF. Now, the very largest ETFs like STW, because they're so heavily traded and so widely owned, that spread between the bid price and the offer price is often much tighter, and they're cheaper to trade than smaller ETFs. So I would say trading for the very largest ETFs is where they have their most significant advantage. Of course, if you're a long-term buy and hold investor, that's going to be a less significant issue. But if you're trading ETFs often, that's going to be a more significant issue. Well, we offer 2 equity income ETFs. The first one, SYI, focuses on higher yielding Australian companies. And the second one, WDIV, focuses on higher yielding global equity securities. However, we find that income-focused investors also use some of our other ETFs, even though they may not have income or dividend in the label. So examples would include SFY, which focuses on the 50 leaders, so those very large cap blue chip income paying companies, or DJRE, which is the global listed property ETF, or SLF, which is the Australian listed property ETF. So there's probably 4 or 5 ETFs like that we find investors who are pursuing income look at. Truth be told, almost all income-focused products are, in a sense, active. So I think the only truly passive products are market cap index products. In other words, products that buy virtually every security in the market and hold it at its market cap weight. And if a product is not buying every security in the market at its market cap weight, it is, in a sense, not really passive. I think the issue is less about active versus passive and more about transparent versus opaque. So if you look at the income equity ETFs we offer, like SYI or WDIV, they follow clearly described index rules. So how we select higher yielding equity companies is clearly disclosed. There are very strict rules built into the index that we track. Plus, we publish the holdings of SY and WDIV every day. So for investors who want higher yielding equity securities, there's a very high level of transparency. It is, in a sense, active because it's not owning every company in the market, but it's highly transparent. And that level of transparency is something that you don't normally see in non-index tracking active products, regardless of whether they're ETFs or traditional managed funds. Look, I'm sure every ETF issuer is looking hard at what the needs of their customers are, and they're looking to improve their ETF offerings and the ability of ETFs to meet investor needs. As the great investment democratizer, ETFs, I think, will continue to offer really transparent and low-cost ways of exposing asset markets. Look, I think for building an income-focused portfolio or model portfolio, to state the obvious, you need to speak to your financial advisor to get the right balance between income and risk. So I talked earlier about the broad thematic with investors using equities for income. That has risk consequences, and it's very important that you speak to your financial advisor to get the right balance between income and risk. I think big picture, we quite like a roughly equal balance between those equity orientated income generating assets like SYI and WDIV, so that you've got that higher yield but higher risk component of roughly half your portfolio, and then the other half in more stable but probably slightly lower yielding assets like government bonds, like investment grade credit, high yield credit, and even cash. I think the key here is diversity. So that's diversity between asset classes, but also making sure that any ETFs you do include are well diversified in their holdings underneath.